Now let's go ahead and review Chapter 9 entitled Current Liabilities. Remember, the term current liabilities relates to obligations that the company has to satisfy in 1 year or one operating cycle, whichever is greater. In other words, if I have a debt or an obligation that I need to pay a vendor or pay an outside party, then I have an obligation or a liability that I need to satisfy. The current means the timing in terms of that. We have to satisfy that obligation within a current time frame. Now, typically when we talk about current liabilities, first of all, we have to understand the characteristics of those liabilities. We have to look at the definition and what that liability is, and that we have to understand whether that liability is a known liability, an estimated liability, or a contingent liability. A known liability is a liability that we know how much money we owe and to whom we owe it to. An estimated liability is a liability that we're going to recognize on our financial statements. However, we may not necessarily know either when the obligation is going to be satisfied, or the other is exactly what the exact dollar amount is going to be, since we have to estimate what our obligation is going to be. An example of an estimated liability could be vacation benefits, bonuses, warranties, and other types of employee benefits. The other or last one in terms of current liabilities that may show up on our balance sheet are called contingent liabilities. And contingent liabilities, just by using the term contingent, mean is that we have an obligation that is going to be an obligation that needs to be satisfied if something occurs. For instance, if we have a lawsuit where someone is suing us, if we estimate that it is probable, possible, or remote, and we know the dollar amount or we don't know the dollar amount, we can build ourselves a little matrix to determine whether we need to recognize it on our financial statements. Do we need to disclose it in the footnotes of the financial statements? Or in the event, if we can't come up with a number, we can't really identify what that liability, where we just don't do anything. Now remember, the whole aspect of liabilities a lot of times comes out because of the matching principle. Because of timing purposes, a lot of times we need to match the expenses to the revenues that we've recognized earlier, as we've discussed, in terms of the revenue recognition principle. The matching principle says we need to match those expenses in the same time frame as the revenues that we've recognized. The problem is that a lot of times the timing may not fall into place where we have to satisfy those expenses in terms of either paying those expenses or paying any obligations that those expenses may develop. We need to make sure that we recognize that we have an expense in the right period, but we also have an obligation to pay those expenses or pay that obligation in the future. So probably the best way to do is we're going to do one exercise and one problem in this chapter to kind of illustrate some of the things that you have to look at when we go through current liabilities. So let's move on to exercise 9-2. Now this particular exercise is an example of how we need to determine whether we need to record the journal entry of a potential liability or do we not record that journal entry. And in this particular problem, it says prepare any necessary entries at December 31st, 2008 for Costco Company's year-end financial statements for each of the following separate transactions and events. So on December 31st, 2008, what we have to look is at these 6 separate situations and determine, do we need to recognize a transaction? So let's go to number 1. It says during December, Costco Company sold 4,000 units of a product that carries a 60-day warranty. December sales for the product totaled $150,000. The company expects 8% of the sales to need warranty repairs, and it estimates that the average cost per unit will be $17 each. So what happens then, if we take a look at this, if we've sold 4,000 units and we sold it for $150,000, the revenue recognition principle says we need to recognize these $150,000 in sales in the month of the sale, which is the month of December. So if that's the case, we're recognizing the revenue. The matching concept says if we can estimate what the expense is, we need to recognize the corresponding expenses to the revenue. So warranty expense is one of those expenses that is related to the product sale. Now, their estimate of those 4,000 units sold is that 8% of these 4,000 units are going to come back for repairs, and it's going to cost us $17. So in other words, if I did a quick calculation here, and I said 4,000 times 8%, 0.08, which is the amount of the returns, times the cost to repair, it's going to cost us $5,440 estimated how much we're going to have to recognize in terms of warranty expense. So we would need to do a journal entry that would be basically debit warranty expense, and that would be in the amount of $5,440. And then we'd have to do a credit of estimated warranty liability. Oops, I misspelled it. Let me make sure I spell it right. In the same amount of $5,440. So what we've done here is we've recognized the expense in the month of December for the estimated amount of repairs that we're going to have to be made, and that since we haven't satisfied that obligation, we're recognizing a current liability called estimated warranty liability for the same dollar amount. So we've increased the expense, increased the liability. Okay, so let's take a look at the second question. The second question says, a disgruntled employee is suing Costco Company. Legal advisors believe that the company will probably need to pay damages, but the amount cannot be reasonably estimated. Now, as you may recall, as you read the chapters and you listened to the lecture, if we take the matrix that we looked at, where we knew the dollar amount or didn't know the dollar amount, and whether it is probable, possible, or remote. If you take a look at that chart, we know the legal advisors say that we're going to have to pay something, but we don't know the dollar amount. So if we go down to that chart to the dollar amount, what it would say is that it's probable that we're going to have to pay it out, but we don't know the dollar amount. Since we don't know the dollar amount, the second item says no journal entry. Now, however, even though we don't do a journal entry, there still is something that we have to do. Because it's probable in nature, but we don't know the dollar amount, we would need to disclose the potential liability in the footnotes of the financial statements. All right, question number 3. Employees earn vacation pay at a rate of 1 day per month. During December 20th, employees qualify for 1 vacation day each. Their average daily wage is $150 per employee. So what we needed to do here is we have to recognize that we have an obligation to pay our employees vacation benefits, vacation pay, when they exercise their option to go on vacation. So what we needed to do is we need to recognize that they have 20 employees that have earned vacation. So what we've done then is that we need to do a calculation where we have 20 employees and they earn 1 day, and The 1 day is worth $150. So in other words, we owe $3,000 in terms of vacation benefits at the time of December. So we need to recognize that we have vacation benefits, and it's an expense in the amount of $3,000. However, the employees have not exercised their vacation benefit, so we owe that to the employee. So we have a vacation benefit payable in the amount of $3,000. All right, situation number 4 says Casco Company guarantees the $7,500 debt of the supplier. The supplier will probably not default on the debt. Once again, go to that matrix and ask yourself the question, is this potential liability probable, possible, or remote? Since the supplier will probably not default on the debt, that means it's going to be really remote that we're going to be obligated to pay that $7,500 debt. Since it's remote, no journal entry required. Now the question is do you need to disclose it? Because we know the dollar amount, the $7,500, and it's a contingent liability in terms of that it's a possibility that it may occur, we would need to recognize this as a contingent liability. So we would have to recognize it as a contingent liability and disclose that on the financial statement footnotes. Now, it would not go as a dollar amount as a journal entry into the general ledger because the possibility of it happening is considered remote. But because we know the dollar amount, we need to disclose it. All right, so let's do the next one, number 5. Casco Company reports an adjusting entry of $750,000 of previously unrecorded cash sales, costing $500,000 and its sales tax at a rate of 5%. So the question then is, what do we have to recognize? We have to recognize that cash has occurred. We need to do the adjusting journal entry to recognize the sale of $750,000, but we also have a potential liability, or we have a liability here, which is the 5% sales tax based upon the $750,000 sale. Now remember, who paid the sales tax? Our customers did. So what we need to do is we need to do a journal entry where we would debit cash, and now we would record how much cash we received, and in this case we would have received $787,500 in cash. Now how did we get that cash? Well, part of it is we got the sales, and of that sales was $750,000 in sales, as we see over here. The other thing we had received from our customer is the sales tax. Now, we're collecting the sales tax, but the sales tax does not belong to us. We're collecting the sales tax on behalf of the government. So we have to recognize the sales tax, but we owe that money to the government as a liability. Now we know what the dollar amount is because it's 5% of the sales. So if we take 5% of the $750,000, we're going to get $37,500. Now, are we complete? Well, remember, go back to a couple chapters ago. We've not just recognized the sale and the liability, but because of the matching principle, we also have to recognize that we sold a product to get that $750,000 sale. So what we need to do is we need to recognize cost of goods sold. And the cost of goods sold, it told us in the problem, was $500,000. Now that cost of goods sold was based upon the sale of inventory, So we need to reduce the merchandise inventory. So we're going to credit merchandise inventory in the amount of $500,000 so that we can record that the inventory is no longer in our possession and that we've expensed it at the same time as the sale. All right, the last question here is the company earned $75,000 of $100,000 of previously received in advance for services. In other words, we received $100,000 from a customer where we didn't do the work. So we had a deferred revenue account or an unearned revenue account. So now we've earned it, so we need to make a journal entry to record that we no longer owe that $75,000. So what we want to do is we want to reduce the liability for because we earned it, so unearned services rendered or services revenue Now remember, unearned services revenue is a liability. So now that we've earned $75,000, we have to reduce it because liabilities normal balance is a credit. And we're now going to recognize the revenue by recognize earned service revenue in the amount of $75,000. Okay? So that's how we would solve each of those different transactions and determining whether we need to do a journal entry or not to recognize the transaction. Sometimes we're recognizing an activity or recognizing an obligation. Sometimes we're adjusting that obligation to reflect activity that's occurred during the year. So now let's go on to the next problem and see how we do with that. Moving on to the next problem, there are times when we're going to have to record journal entries to record sales transactions, but also corresponding expense transactions that match with those revenues. So let's take a look at this particular problem. On October 29, 2007, Lobo Company began operations by purchasing razors for resale. Lobo uses the perpetual inventory method. If you remember, the perpetual inventory method from an earlier chapter means that we have to recognize the cost of goods sold at the same time that we recognize the revenue. Remember, the periodic method, we waited till the end of the period, but the perpetual method, we recognize the expense at the same time of the sale. Continuing, the razors have a 90-day warranty that requires the company to replace any non-working razor. When a razor is returned, the company discards it and mails a new one from merchandise inventory to the customer. The company's cost per razor is $20 and its retail selling price is $75 in both 2007 and 2008. The manufacturer has advised the company to expect warranty costs to equal 8% of dollar sales. The following transactions and events have occurred. And so what we have listed here are a series of transactions for the year 2007 and 2008. So first of all, what we want to do is we want to go ahead and consider what the journal entries would be if we were to recognize all these transactions. So the very first transaction in 2007 was that they sell 105 razors for $7,875 in cash. So in essence, what we have to do is we have to recognize the cash. So we're going to debit cash for $7,875. And then we're going to credit sales for the same amount. Now that would be fine if we were a periodic inventory. However, the problem says that we're doing a perpetual inventory. And in a perpetual inventory, we need to recognize the sales transaction, but we also have to recognize the cost of goods sales for the inventory items that have been sold to our customer. So what we need to do is we need to do a debit entry to cost of goods sold in the amount of $20, which is the cost of the new razor, times 105, or $2,100. We have to do a credit. Since we sold the product, we no longer have that inventory available to us anymore, so we have to reduce the asset merchandise inventory by the same $2,100 amount. So what we've just done is we've recognized the sale, but now on November 30th we have to recognize the warranty expense related to this sale. Well, the warranty expense, as it says, is supposed to be 8% of the selling price. So if our selling price was $7,875, we need to take 8% of that and recognize warranty expenses. So we're going to debit warranty expense, and the warranty expense is going to be the amount of the sale times 8%, or $630. Now, granted, it's the $630 is a warranty expense. However, we haven't had the product come back yet, so we have a liability or an obligation that we have to satisfy. So what we've got here is estimated warranty liability in the same amount of $630. Let me fix my typo here. Alright, so we've recognized the warranty. Now let's move on to the next transaction. On December 9th, we replaced 15 razors that were returned under warranty. So if the razors are being returned, what we have to do is that we're going to recognize that we're going to provide a product to the customer, and we're going to take it out of merchandise inventory, and we're going to reduce our obligation because we've just satisfied our obligation. That obligation was called estimated warranty. Estimated warranty liability, we replaced 15 of them. Now 15 of them at a cost of $20 is $300. And we took them out of merchandise inventory in the amount of $300. All right, now on December 16th, now we go ahead and we sell more razors. So once again, we debit cash. We receive $16,500 in cash. We recognize the sale in the amount of $16,500. Once again, because this is a perpetual inventory, we have to recognize the cost of goods sold. So we debit cost of goods. Goods sold. Now the cost of goods sold, once again, how many razors did we sell? We sold 220 razors times a cost of $20. So we're going to get $4,400. We have to take it out of merchandise inventory. For the $4,400. All right. So now so you can see that this first journal entry that was for November 11th is almost identical to the journal entry that was done on December 16th. All it is the difference in terms of the dollar amounts. Now on the 29th, we replaced 30 razors that were returned under warranty. So once again, we're going to debit, since they were replaced, we're going to debit the estimated warranty liability once again, we replaced 30 of them, so 30 times $20 give me $600. We took it out of merchandise inventory. For $600. Now the next journal entry on the 31st of December says recognize warranty expense related to December sales with an adjusting entry. So once again, similar journal entry as the one up here. We're going to recognize the warranty expense, recognize the liability. So we're going to debit warranty expense. The warranty expense is going to be 8% of the sales again. So 0.08 times the amount of our sales, which is $16,500, and we're going to get $1,320. Because we haven't satisfied it yet, we're going to debit estimated warranty liability in the amount of $1,320. Okay, so those are all the journal entries that we have made in the year 2007. We can do the same thing for 2008. And in 2008, we sold 150 razors. So once again, we debit cash. And we're going to receive $11,250. We're going to credit the sale for $11,250. Next, we're going to pick up the cost of goods sold again. Debit, cost of goods sold. Cost of goods sold, once again, we sold 150 razors times $20. Oops. And we're going to get $3,000. Next, we have to reduce merchandise inventory. For $3,000. Okay, on the 17th, we replace 50 razors. So once again, we have to show that we're no longer liable for those 50 razors that are being returned. So we're going to debit estimated warranty liability. Now, how much was the warranty liability again? 50 razors times $20 per razor, or $1,000. We have to take it out of merchandise inventory. For the $1,000. And then the very last transaction here is that we're going to recognize the warranty expense. So debit warranty expense. And again, it's 8% of the sales times the sale. Oops, my formula didn't work, so let's try it again. It's 8%. Our sale again. There we go, $900. We're going to have estimated of $900. So here's what we have in terms of journal entries. Now notice if you look at these accounts, the cash account is a permanent account, whereas sales are a temporary account. As you recall in an earlier chapter, when we have multiple years, permanent accounts do not close out, whereas temporary accounts do. So keep that in mind when you're trying to ask the question, how much is the warranty expense for each year? Or what's the ending balance of the warranty liability? So now what we want to do is, let's do this. Let's now take a look at how we would calculate that by looking at a series of T accounts. So now let's post our journal entries that we've made for the years 2007 and 2008 into our general ledger. Now what I've done here is I've created the T accounts for our general ledger accounts so that they can represent our ledger as we post the debits and the credits. So for instance, let's start with 2007, Up here where we have debit cash, credit sales, we want to debit the cash by $78.75. We need to credit sales by $78.75. We need to debit the cost of goods sold by $2,100. And we want to credit merchandise inventory by $2,100. So notice all we're doing is we're taking the debits and credits and posting them into our ledger. Next, we take our debit to warranty expense over here. Warranty expense is $630, and we have to credit the estimated warranty liability of $630 as well. Next, we want to debit the estimated warranty liability over here. Debit the estimated warranty liability for $300. Credit merchandise inventory by $300 as well. Next, the set of transactions here. Debit the cash by $16,500. Crediting sales by $16,500. Debit the cost of goods sold by $4,400. Crediting merchandise inventory by $4,400. Estimated warranty liability debit for $600. Merchandise inventory by $600. Next, the warranty expense. We debit warranty expense over here for $1,320. Crediting the estimated warranty liability of $1,320 over here. Now let's stop here right now, because what I want to kind of show you is these were all the transactions for 2007. Notice I placed these columns of T accounts in the order of the accounting equation, that here is our assets, here's our liabilities, and here's our income and expense items as it reflected towards these journal entries. Now, one of the things to remember is that asset accounts and liability accounts are considered what we call permanent accounts, whereas accounts related to the income statement, such as sales, cost of goods sold, and warranty expense, are considered temporary accounts and will be closed out at the end of the year. So in other words, once we finish our journal entries right here for 2007, we need to consider that these accounts will flow into the next year. However, these accounts, these temporary accounts, will be closed at the end of the fiscal year, and when they're closed, these accounts will be zeroed out so that we can start all over, so that we can recognize sales, cost of goods sold, and warranty expense for 2008. If you don't recall the discussion here, go back to the chapter where we were talking about adjusting journal entries, and the adjusting journal entries were specifically related to closing of the books. Now, let's take a look. So what the question in this problem said, what is the amount of the estimated warranty liability at the end of 2007? What you want to do is take your debits and your credits to determine how much do you have. Now remember, estimated warranty liability is considered normal balance is a credit. So I want to add the 1,300, so we'll just do this way. And we can go up here, and we can add this item here, plus this item here, minus our debits, $300. And so our estimated warranty liability, after taking consideration our credit balances and our debit balances, is our estimated warranty liability is $1,050. We can add up our sales to find out how much our sales are, add up our cost of goods sold, and estimate our warranty expense. Now I'm going to let you do the rest of this problem, but what we just remember because these three accounts are permanent accounts, you need to know what this number is for the warranty liability, because that's the beginning balance for the next year. We don't have enough information to determine what the beginning balance or an ending balance for cash is, or what the beginning or ending balance is in merchandise inventory. But because this is when they started it, we do know that the 1050 is the ending balance for 2007 or the beginning balance in 2008. When we close out our books, sales will go to zero, cost of goods sold will be zero, and warranty expenses will be zero. So go ahead and try 2008 by posting these transactions here and see if you can determine how much is the warranty liability and how much is the warranty expense for the next year.